Hi everyone, I'm Ken from TradingKS and the CTKS method. Today we'll dive into the hottest news that's shaking up the stock and crypto markets. We'll analyze crucial Fed data and decode the charts for real market signals. To help you plan your next moves, there's a lot of exciting data to come. Let's run the numbers. The Nasdaq 100 has been rallying as it's neared oversold levels, and we can see it was overbought up here and it's been oversold. This is according to the RSI. Now, when we look at the actual Nasdaq, the Nasdaq Composite Index, from a structural perspective, what are we seeing? When we look structurally at any specific chart, what we're seeking to understand is all of price action. This is the Nasdaq Composite Index, not just the 100, but everything. We can see that the Nasdaq, over many days, just leading into the start of August, was trying to get above that 17,561 structural level of resistance. Unfortunately, it failed. It then broke through the 16,957 mark, and there was a bit of structural support there, but it quickly fell through. Why was this the case? The Japanese carry trade was amongst the biggest reasons. We've seen a really good response to risk-on activity, but price is just simply always moving between structural resistance and structural support levels. What we can see currently is the Nasdaq Composite is 17,187. We have the opportunity to come back and retest the 16,957 and resume upwards to the 17,561, or even rally up to that level. That's proved to be quite significant resistance in the past. The bulls will be looking for that 17,561. The bears will be looking to retest that 16,478 level. Just be aware there's quite substantial structural support around that level. That means that the buyers will step in, and at 17,561 the sellers will step in. Equity flows from 2008 to the present time indicate that we've got weakening flows into the market through August, September and October. Then they start to pick up, the so-called Santa Claus rally. When people are new to financial markets, they just look at price action, the randomness of it, never realizing that structural support and structural resistance levels are the entire key to understanding where price can go. Price is always bounded by structural support and structural resistance levels. When you get a lot more structural resistance, that's harder for price to come up through there. You generally see a lot of consolidation in these cases, and if it doesn't break through, you would expect it to come down to lower structural support. Looking at the S&P 500, and these structural levels are accounting for over 55,800 days worth of data. And we can see that the S&P 500 has currently closed out at 54.34. There's overhead structural resistance between 54.84 and 55.43. The bulls would expect to just reach up to the 55.43, but we could see consolidation action. The bears will be seeking to push down the price of the S&P 500 to the 53.54 and below to the 51.27 mark. These particular pockets of air are called negative fresh air gaps or positive fresh air gaps if price is above it. When you get a negative fresh air gap, price can move down very quickly. But when you get a positive fresh air gap, price can move up very quickly. So that's why we see all of this variability inside the market at times like this. And this has been driving the VIX crazy. The media is reporting today that the recession probabilities have risen across asset classes. When we compare March, which is that black line, to August, which is the gold line, you can see that the recession probabilities have been increasing right across the board. Now, what does this mean? It simply means that there was negative price action inside the market. When there's negative price action, what do people do? They apply the goldfish bowl principle. They swim around once, the waters change, and they say, oh no, it's the end of the world. Inside our community, we don't care about bull markets and bear markets. They make no difference to us. You can make money in either market. And the market implied US recession odds are increasing. They're currently at 41%. We can see that they've been coming up after going down. Now, why have they been coming up? Because of the VIX. The VIX and the Japanese carry trade have disheveled financial markets. And of course, we've got wars breaking out right, left, and center as well. People are addicted to the news, but they should be addicted to the charts. When we look at junk bonds, this is a very, very good indicator of risk on or risk off sentiment inside the market. And we can see that junk bonds, currently trading at 95.57, is breaking into a positive fresh air gap. This could put pressure on the markets to fulfill their upward resistance levels, like we just saw on the S&P 500 and the Nasdaq. If we get some negative price momentum, we can see that junk bonds has a level of structural support just below where it is at the current time. That means we could just reach back and just resend it upwards. The bears would be seeking to drop below that 95.30 level and push the price down. When people are new to trading and investing, they only look at the charts that they put money into. If they don't put money into a chart, they just pretty much ignore it and say, it just doesn't matter. But in truth, the Tier 1 charts are the engine of financial markets globally. What's happening with the VIX and what's happening with the S&P 500, the Nasdaq, the Dow, and the Russell are really important. Bitcoin, because it trades 24 hours a day, 7 days a week, can give us really good risk on and risk off sentiment indicators. Total crypto market cap shows us how the rest of the crypto market is going. When inflation is designed to hit the markets, and I mean designed, you see the US 2 and the US 10-year come up. Junk bonds go down. All of this filters into gold and silver prices because they're real yield dependent. And if the major indices are going up, we expect the subcomponents of those indices to be coming up as well. If Bitcoin is registering risk-on activity, we expect the subcomponents of the crypto market to come up as well. It's just like the stock market. And one thing, those bounded areas are called CTKS structure, and they determine where the price waves up and down from. For consistent profitability, just have 3 simultaneous strategies playing out at all times. Understand, the price is always moving up and down in a wave-like fashion. Now, what does that mean? It can come down and go up and come down and go up. It just does this, even though it's going up overall. And if price is coming down, it goes down and comes up. It goes down and comes up. So it's just a matter of preparing yourself and getting ready for any market volatility. The CPI data release is a really important data release for the markets because if the CPI is coming down, we expect the Fed to cut interest rates, or more particularly the federal funds rate. The US producer price inflation came down. Now the PPI is a leading indicator of the CPI. If this is coming down, we would anticipate that the CPI come down also. Markets have become addicted to the sugar rush of money printing, but Fred Bostic wants a little bit more data on the economy before cutting rates. One thing that we do inside the CTKS family is that we look at the data, not at the words. The next FOMC meeting is approximately 35 days away, and you can see that the current target range is between 5.25% and 5.5%. We're seeing the degree of cut that could come through or the degree of easing. The question is, do we get a 25 basis point decrease in the federal funds rate or a 50 basis point increase? If we get a 50 basis point increase, it points to the fact that the financial markets are broken. They're not healthy, they're broken. The federal funds rate has a big influence on currency, and the DXY just tends to crater when the federal funds rate gets cut. When the federal funds rate goes up, the DXY goes up with it. But if the federal funds rate is cut, we expect the DXY to go down with it. Not just in a line, but in a structural support and resistance type fashion. And we can see that we've reached a level of structural support at 102.55. But we would expect further weakness inside the DXY. When the DXY finds structural weakness, we also anticipate structural weakness inside the US 10 and the US 2. And we can see that currently the US 10-year yield, 3.845%. We're coming up to a structural support level, so we could get a little bit wobbly around here. But that negative fresh air gap, combined with the concept of a cut between 25 and 50 basis points, we should see the US 10-year coming down as well, unless that CPI print comes in hotter than anticipated. Also, how is this playing out on the US 2-year yield? You can think of the US 2-year yield like your savings deposit and the US 10 like your mortgage rate. We can see that we're in currently a negative fresh air gap. We're moving down to a level of structural support, but there's a negative fresh air gap, so we could easily overshoot this and resume downwards. If the CPI print comes in not hotter than anticipated, probably as anticipated or better than anticipated, which means it would go down. If the CPI figures come down, that means that inflation is being caught. If inflation is not being caught, the CPI prints hotter than anticipated, all of these particular charts on row 1 of the cheat sheet will start to register positive impacts, and that is not good for the markets. We don't want that. We want the other way. Not surprisingly, Crypto Trading KS and the CTKS method is literally all about crypto, but to understand crypto, which is the most volatile asset class on the planet, you must, absolutely must, look at the Tier 1, Tier 2, and Tier 3 charts in order to gain perspective on how the market could move. If risk off is coming into the market, Bitcoin and total crypto market cap will get hit. Hopefully, this is explaining why the CPI print is so important. It's red hot in terms of its importance inside the market. We want a lighter than anticipated. We don't want hot prints here. We want cold prints, because that will heat the market up, if you know what I mean. We've seen the markets just bounce around between technical support and resistance levels, and boy oh boy can it bounce. When we get a positive bounce, everything looks pretty good. And it's almost as if all of those red days were never there, but they were there. And a red day is simply nothing more than price moving down to a structural support level or structural support levels if it really comes down through a negative fresh air gap, finding that support and rebounding to structural resistance and doing the dance. That's all that happens. But how is the market dealing with this at the current time? We can see that there's a lot of fear inside the market. It's actually extreme fear inside the stock market, and that has persisted for a week. Why are we seeing these increased levels of fear inside the market? A lot of it has to do with the VIX. The VIX spiked up at levels not seen before the 2008 financial crisis and the COVID sell-off. Of course, this has unshoveled a lot of positions. When the VIX rises above 35, as it did on August the 5th, it's taken an average of 170 sessions to return to its long-term median. This means that the markets are really volatile. Tracking the VIX is particularly important. That's why it's a Tier 1 chart. And you can see this overlay. This is the March 2020 crash. As you can see also, we've fallen below that. Why did we spike up? Well, the theory is a couple of major things. One was the Bank of Japan and unwinding of the Japanese carry trade, which did carry on. But as the Bank of Japan said, oh, okay, we won't raise interest rates here, the S&P 500 put in its biggest one-day gain since November 2020. And of course, the Iran-Israel situation is still yet to resolve itself. In times of market volatility, it's really important to understand where your levels are, where is structural resistance and where is structural support, right across the Tier 1, Tier 2 and Tier 3 charts. It's absolutely vital, or else you're just going to panic like hell. Our global family does something called borsogging, which is buy on red, sell on green. And it doesn't matter if it's an uptrend, you can always buy on red and sell on green. It doesn't matter if it's a downtrend, you can borsog there. It doesn't matter if it's consolidating. Therefore, when it comes to investing, that's good for buying. People who invest are specialists in hitting the buy button. People who trade are specialists in hitting both, the buy and the sell. But the problem is, when you invest, you basically, because the buy button is the only thing that people tend to hit, you have to have a bull market. If you're in a bear market, investors have a terrible time, or a consolidation market as well. That's a shocking time. Therefore, if you can learn to invest and also trade, that's what you want to do. Just practicing. Now that we can basically see that risk on is potentially inside the market unless we get a bad CPI print, let's pop across to crypto, because Bitcoin and crypto help you to understand where the stock market is going, because they trade 24 hours a day. And Bitcoin and crypto go unmentioned in the Trump-Musk X space speech or interview or chat. A crypto-specific movement has just come in. Nearly $2 billion has been moved from a Mt. Gox wallet. Now, this is quite interesting because we still hold 46,000 Bitcoin in the Mt. Gox wallet, and that's down from 141,000 on July the 1st. So just to be aware that we may get some negative price volatility inside the crypto market that may not be related to the stock market. One thing that you find when you're looking at different news articles, you'll get both sides presented. Bitcoin investors show renewed interest in accumulation and holding from Glassnode. But you'll also get some negative articles as well. This is especially true inside the stock market. Interesting news today, Bitcoin hits 61,000 as Marathon Digital invests $250 million. Often you get news headlines that say, this caused this because Marathon Digital did this. Bitcoin went to 61,000. Financial markets are a heck of a lot more complicated than just that. But this is good news. And don't forget, it's just announced it. It hasn't done it, it's announced it. Therefore, what is the best way to navigate all financial markets? It's just to know where the structure is. If you know where the structure is, you know where things are bound to reflect from. For example, we were up here just above that $2.11 trillion mark, and then we lost structural support and we rebounded to a lower structural support level. Then we popped up to the structural resistance level. If you know where these levels are, you'll understand where price can go from a bullish perspective or a bearish perspective. So that's why you just need to get the levels, and the levels are not all equal. You can see that this level here, that one there, is lighter than this one here. Therefore, this is stronger. And you can see down here at that $2.012 trillion mark, this is total crypto market cap. That's pretty strong. But you have a negative fresh air gap. Those negative fresh air gaps can cause an overshooting of structural support levels if the price comes down. But that's just something to be taken advantage of. And the Metfied CEO predicts Bitcoin to hit $100,000 and Ethereum $4,000 by the year end. But where is it going right now, and where is it going in the next 24 hours? In yesterday's video, we talked about A, B, C, and D. We can see that in the following period of time, we came up and hit that A level, and now we're just slightly below it. So let's just do it again. Where do you think price will hit in the next 24 hours? Is it A, B, C, or D? And everything is structure related. Note that we were coming up to B. We failed to confirm it to move up to A. So we needed to gain strength at the C level. When we did so, we came back up to B, this B here, and we just forged ahead through that A level. But notice how that C level of structural support has been holding, and it did hold the entire crypto market yesterday. So please let me know in the comments, what are you thinking? A, B, C, or D? A lot of people drive themselves absolutely crazy when it comes to reading the news. 3 reasons why Bitcoin could be a risky investment if a recession is predicted. And also, what about this? Gold as a leading indicator for Bitcoin suggests an imminent rally as Bitcoin climbs above 60,000. A lot of people love the news, and hey, what's not to love about the news? But the news is just like driving with 3% visibility. It's not a good thing. But the key is, we don't care if it's a recession or anything else. We're just borsogging. We know that price is just going up and down and up and down between structural support levels. What do we care? So, just something to consider. The evolution of technology, we went from the candle to the electric light bulb. We went from horses to motor vehicles, and we're soon going to electric vehicles and then hovering cars and then space flight. What about the news? It used to be printed, believe it or not, and now it's all digital. And what about money? It used to be printed, now it's all digital, believe it or not. And Bitcoin is now the 6th top monetary asset globally, coming in at $1.19 trillion. And it's coming for gold. Ken, how can you say it's coming for gold? Well, gold is like the horse and buggy of years gone past, and streets used to look like that, believe it or not. But then things started to turn around, and those horse and buggies were replaced by these newfangled things called automobiles. And automobiles didn't need horses, they didn't need stables, they took over. And you'd be hard-pressed to find a horse and buggy right now as a major form of transportation. One thing to note, when the markets go green, they can go really, really green. This is the past 24-hour performance. And we can see that Bitcoin is up, it's done quite well. And also near Aptos, Stacks, Rune, Phantom, quite a few. When we look back to the past 7 days, not the past 24 hours, but the past 7 days, we can see a lot of cryptos have come up really quite well. It makes us forget that 30 days ago, the market wasn't looking that crash hot. In fact, double-digit losses from 30 days ago. This is why it's important to keep your losses really small as you trade. Investing is a different thing, but as you trade, you must keep your percentage loss small. Looking at the Bitcoin ETFs, we can see total volume 1.29 billion, market cap 57.37 billion, and total assets under management of 48.77 billion. In the last 24 hours, we've had an outflow. We had an inflow the day before that, a major outflow the day before that, and a major inflow and major inflows. In other words, it's all over the place. Looking at the past 24 hours, we can see Bitcoin up 3.19%, Ethereum up a little over, well, nearly 1.5%, BNB 2.24%, Solana 2.7% up. Don't worry about USDC or USDT. They're stable coins. What are stable coins all about? Well, they're supposed to maintain their dollar peg. And we've seen XRP up, TON up, and Doge up as well. The greatest gainers in the past 24 hours, Rune is taking the pole position, followed by Stacks, Immutable X, Akash Networks, Nia, Celestia, Aptos, Phantom, and Arweave. No matter what the market conditions are, there are always opportunities inside the crypto market. And the greatest losers past 24 hours, Sui, Quant, Monero, SEI, Mantle, KuCoin, Atom, Leo, and Tether Gold. In the past 24 hours, we've seen liquidations of just a little north of $100 million, with about 60% being short and 40% being long. This has put positive price momentum inside the crypto market. In this video, I have tried to show you how intercorrelation and interdependence of CTKS structure is just money in the bank. If you understand where the structure is and how the charts relate to each other, you start to just move from fear into confidence. And just be aware that the noise that comes from financial markets is mainly from the news. So what you need to do is to get independent from the news and just focus on the signals. That's what we do here each and every day. Following the crowd is not the best idea because the crowd tends to end up on the wrong side of the trade often. If you would like the indicators that I use, you can just pop across to CTKSMethod.org and there's a service that you can subscribe to. You'll get TradingView indicators that you can pop on your own charts. Or if you would like to learn how to do it yourself, which I really recommend, you can do the standard certification, of which there are 2 levels. Our newsletter is coming soon, so please subscribe to that. That's completely free of charge. And the cheat sheet is also there, so you can pick up that as well. You will find that getting independent of the news is the best thing that you can possibly do. And you just need to have a look at the structure on the Tier 1, Tier 2, and Tier 3 charts. That structure will save you, literally. If you like this kind of analysis, please let me know. Hours and hours are spent on this, so you don't have to. If you find the content useful, please smash that like button, and if you're new, please subscribe. We'd love to have you as a part of our global family. And you might like to just put in the next 24 hours, do you expect it to go to A, B, C, or D? Have a great one ahead, my friends. Catch you again in the next video.